The last few years of global financial action must be so confusing for most people who stand on the periphery of what's really going on. And that's just about everybody. Will Greece default? Will America recover? What about China? What about gold? The questions just go on, and no one can really say with any conviction how things will work out. So what should you do when you're trying to manage your own financial affairs through this soupy mess? The answer is to rely on what is and not what logically should be. And the only way to accurately gauge what is going on is to use an element of technical analysis to help formulate your decisions, because that's what's giving you the real story, not the one that's conjured up by the financial media, who overwhelmingly don't have a clue as to why certain events are happening. Now, I'm not implying we should completely ignore the fundamental facts about what's going on in the global economy, because that provides us a valuable longer-term context in which to base decisions emanating from our analysis of charts. But we just need to keep that information flow in perspective and recognise that markets regularly ignore the fundamentals for long periods of time. The reason that happens is that markets are forward-looking beasts, and they try to anticipate what will happen. That means many assumptions are being made which may turn out to be true or not true. So let's consider a couple of the key aspects of what's going on at the moment. Firstly, this bailout debacle in Greece is just that. It's a debacle. It solves nothing and is only designed to buy time. Greece must eventually default, as there is seemingly no way out for them with a rapidly contracting economy that has to reduce their debt to GDP ratio over the next decade. The two processes are mutually exclusive and can't occur at the same time. Growth requires economic stimulus, which means more debt if your budget is not in surplus. The problem is that the political process, or self-interest if you like, that created this extraordinary debt mess is now trying to fix it. And that's not remotely likely in my view. The issues since before the 2008 GFC are essentially a banking problem, with the whole global sector having to go through a massive deleveraging that will take a very long time to work through. Just look at Japan, which is still stuck with a deflationary economy more than 20 years after their initial asset crash. Now, the euro as a concept, to my mind, was always going to fail, because how can a group of countries which are poles apart in culture, work ethic, productivity, etc., possibly exist under a single currency? The natural balancing process is that as a country becomes less competitive, its currency value falls to compensate and therefore restore that competitiveness. Now, the euro stops that process occurring. So eventually we'll see a different structure and some sort of different currency in Europe. And that will cause a painful period of transition for all of us. Europe's a mess, and being the world's largest economy collectively, the ramifications are going to be felt for a long time to come. However, for those who know where to look, then the opportunities are amazing. Now, the second reality is that there's a massive fight going on globally between the forces of inflation and deflation. Banks, central governments, and central banks in particular hate deflation because it threatens to unravel the big Ponzi lending scheme of the last 5 decades and bring everything down, including them. Therefore, they are and will continue to be intent on preventing deflation by this continual creation of new money that they engage in. The main force is deflation because the psychology of the masses around the world has gone into reverse, and it's gone into deleveraging mode, which means that people are no longer assuming that what they buy today will be worth more tomorrow. This means that buying decisions can be delayed, and it starts a natural spiral. When stock markets sell off because the reality hits home to investors about what's really going on, central banks inject massive quantities of new money to create a temporary rally. There are so many parts of the stock market that rely on this liquidity for survival because their business models are just no longer relevant in the real natural world. However, there still are parts of the economy where stock prices are underpinned by solid principles of supply and demand and good business practice. Areas like oil, precious metals, copper, power generation, and steel-making materials are the obvious examples. The reality is that as the world's population is still growing, and nearly half of it is emerging into a far more urbanised and industrial society, which is creating unprecedented demand that's going to last for decades. The commentators who are calling commodity prices as being unstable and unsustainable are only looking at a small part of the picture, and they're drawing erroneous conclusions. Therefore, your money should be focused where the main trends are. And these are owning precious metals and also gold producing stocks in particular. Secondly, developing a portion of your investment portfolio around the strongest businesses which are returning a rapidly growing and reliable dividend stream to their shareholders. This takes the pressure off capital gains as being the primary method of wealth creation. And in the future, we are going to have years where there won't be any capital growth. And the third area is to hold some cash to buy the inevitable bargains that will occur in a very volatile price environment. Now, to efficiently be able to read the naturally occurring cycles in the market is called charting or technical analysis. When investors start buying companies which they assess to be undervalued, thereby creating a trend, they don't suddenly stop that buying and change their mind. They keep buying until there is no value in doing so anymore. And generally then the masses take over and they buy because they just heard the price is rising. They have little idea of value and they mostly push prices to an excess before the next downturn. This creates a cycle of oversold and overbought conditions which smart investors can take advantage of to make a great deal of money once they know how to read crowd behaviour through charts. To know that this is true, you only have to ask why stock markets rise well before the media tells you an economic recovery is here. It's because the media has no idea and the smart money does. It is just that simple. And you can swing off the tails of the smart insider money if you know where to look and know how to interpret or can associate yourself with someone who is skilled at doing just that. It is possible for you to learn how to formulate your own decisions. It just takes a bit of learning, some application, but particularly some support while you develop your skills. If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.